U.S. stock market, AI bubble or rational growth. In October 2025, U.S. stock markets came under severe pressure following a sharp rise in interest in artificial intelligence, AI, raising concerns among investors about the possibility of a secular bubble. The topic is becoming increasingly pressing: how justified are expectations, and what are the risks for markets and the economy as a whole? Chart with upward trend. What's driving markets now? The technology sector is once again in the spotlight. Many investors have shifted their focus from the traditional giants, Apple, Microsoft, Google, to companies directly involved in the development and implementation of AI startups, cloud platforms, and chip makers. The rapid growth of these companies' stocks is fueled by expectations of large profits, breakthrough products, and mass automation. However, there is much uncertainty. How quickly will businesses be able to generate profits from AI products? Many companies are still in the investment phase, researcher salaries, infrastructure, model training, and are not yet generating significant revenue. Competition and technological risks. New approaches are constantly emerging, and what's considered a breakthrough today may be obsolete in 6 months. Macroeconomic challenges. Interest rates, inflation, global supply chains all impact the cost of capital and the ability of companies to scale. This combination of growth expectations and actual costs and high competition makes the sector a candidate for overheating, and many experts are asking, when might the AI market burst? Risk indicators, when a bubble is approaching. Here are a few signals to watch out for. Deviation from fundamentals. When stock prices rise faster than their actual earnings or projected cash flows, this is a classic sign of overheating. High volatility and movement without news. If stocks bounce up and down without any visible fundamental action, no announcements, contracts, or quarterly reports, this could be a sign of speculative behavior. Widespread adoption among retail investors. When small and inexperienced investors actively enter hyped companies using loans or margin, the risk of a downside increases. Leverage and debt burden. Many tech companies and startups use debt financing. If revenues begin to lag expectations, debt will become a liability. Correlation of all new ideas. When the entire market wants to be in AI, and everything suddenly underpins this theme, this reduces diversification and increases the risk of a systemic correction. Global context: why the AI bubble isn't just an American problem. China and Asia are actively investing in AI, competing and creating their own ecosystems. Eurasian countries and the Middle East view AI as the foundation of long-term development, but their markets are less liquid and more vulnerable to external shocks. Regulation and ethics. Many countries are strengthening control over AI, privacy, security, and liability. These measures could slow growth and investment. How to proceed with caution as an investor. Diversification is your key friend. Don't invest all your capital in hot topics. Maintain a balanced portfolio with stocks from different sectors: technology, industrials, healthcare, consumer discretionary. Look at growth metrics, not just rumors. Pay attention to revenue growth, margins, P/E ratios, and debt load. If a company continues to lose money year after year despite the hype, this is a warning sign. The DC/DR approach: dollar cost averaging / down rounds. If you're entering a hyped stock, buy slowly, not all at once, to reduce risk. Monitor market sentiment and external factors. Changes in interest rates, geopolitics, monetary policy, all of these can change the picture. Be prepared for a correction. If the market is deflating, it's important to make decisions without panic, take profits or hold on to a portion for long-term growth. Possible development scenario. Correction scenario: moderate. The stock market heavily tied to AI could fall by 20 to 30%, while other sectors will survive or even strengthen. Crash scenario: bubble. Technological obsolescence, AI model errors, regulation, and high debt loads could all combine to cause a collapse. Such periods are reminiscent of the dot-com bubble of the early 2000s or the housing market crash of 2008. Sustainable development scenario. Only some companies will survive and become leaders, the rest will fade away. New technologies will become firmly entrenched in businesses, but growth will be stable, not drastic. Conclusion. The AI market isn't just a trendy topic, but a massive technological shift with the potential to transform the economy and society. But like any powerful trend, it's susceptible to overheating. Investors should remember, look beyond the hype, but also at the fundamentals, manage risks, and diversify their portfolios. Even if the entire sector doesn't implode, overly hyped companies could very well fail.